Have you ever looked at a chart and just wondered, is this thing about to run out of steam, or is this big sell-off finally over? Well, today we're diving into the blueprint for a tool that's designed to answer exactly that, the Relative Strength Index, or RSI. Let's get right into it.
So think about it. How do you actually measure the mood of the market? How can you tell if everyone's caught up in a buying frenzy, or if a sell-off is finally just running out of gas? This idea, measuring market momentum, that's the core question we are tackling today.
And a very popular answer to that question is a tool called the RSI. You can just think of it as a simple but really powerful momentum gauge for pretty much any market out there.
So what is it exactly? Well, the Relative Strength Index is what we call a technical indicator. It measures the speed and the strength of price changes. And its main job, the reason it exists, is to flag two critical conditions when an asset might be overbought or oversold.
And how does it work? The calculation behind it is actually surprisingly simple. The RSI just looks at a set period of time. Usually it's 14 days or 14 hours, whatever time frame you're looking at. And it compares the average gains on the up periods to the average losses on the down periods. And then it crunches that into a single momentum score.
So this brings us to how you actually read the thing. And honestly, the best way to think about the RSI is like a speedometer for the market. It's just showing us how fast that momentum is really moving.
And that speedometer? It uses a super simple scale. The RSI value is always a number between 0 and 100. That's it. This fixed range is what makes it so easy to read and interpret with just a quick glance.
Now here's where it gets really interesting. This scale helps us identify two key concepts: overbought and oversold. Overbought basically suggests that buyers have been pushing the price up really fast and, they might be running out of steam. Oversold is just the opposite. It suggests sellers have been in total control and their pressure might finally be easing up.
So the key to using the RSI is knowing where to look on that 0 to 100 scale. There's certain zones that act like big warning flags, signaling that the market might be getting to an extreme point.
Let's break down the scale. It's really split into three key zones. When the RSI drops below 30, the market is considered oversold. This is the territory where sellers might be getting exhausted. On the other end, when the RSI climbs above 70, the market is overbought, which suggests the buyers might be getting a little too ahead of themselves. And everything in between, that 30 to 70 range, that's just neutral territory.
Let's really focus on that upper limit for a second. When the RSI gets above 70, it's a serious warning sign. It means recent gains have been way bigger than recent losses. This suggests that the buying frenzy might not be sustainable and the price could be due for a correction, or at least a little breather.
And on the flip side, when that RSI drops below 30, it's telling us that the selling pressure has been really intense. This is a heads up that the downtrend might be losing its power, and a potential bounce could be just around the corner.
Okay, so we get the zones. We know how to read them. But the real question is, how do traders turn this information into an actual plan? How do you go from data to a potential action? Let's start with the potential buy signal. This signal is all about spotting that exact moment when the selling pressure finally gives up and the buyers start to take over.
So here's the classic sequence for a buy signal. First, you watch the RSI drop below that 30 level, entering the oversold territory. But, and this is the most critical part, the signal doesn't happen yet. The real signal for a lot of traders is step 2, when the RSI climbs back up and crosses above that 30 line. That crossover suggests the sellers have lost control and momentum is now potentially shifting to the upside. And as you've probably guessed, the sell signal works in the exact opposite way. It's designed to catch that moment when all that strong buying momentum starts to fizzle out.
It's a mirror image. First, the RSI pushes up above 70, showing all that intense buying pressure. But again, the trigger, the actual signal, happens when it then falls back below that 70 line. That drop is the potential sign that the buyers are tapped out and momentum could be shifting downward.
All right, before we wrap up, we have to talk about the most important part of this whole blueprint. The RSI is an absolutely fantastic tool, but you have to remember, it is a tool, not a crystal ball. It needs context.
I mean, look at this quote right from our source material. This is probably the single most important thing to take away from all of this. Relying on any one indicator by itself is just a recipe for disaster. The signals from the RSI are most powerful when they're confirming what other tools are also telling you. So here's a quick checklist to keep in your head. First, never ever use the RSI in isolation. Second, and this one is so important, you have to be aware of strong trends.
In a monster bull market, the RSI can stay overbought for a long time without the price dropping, and the same is true for strong downtrends. Context is absolutely everything.
So at the end of the day, the RSI doesn't give you answers. It just gives you clues. It flags a potential shift in momentum. The real question that this leaves us with is this. Knowing what the RSI is telling you, how are you going to combine this tool with others to build a complete and robust trading strategy? That's the real challenge.